Walk me through some thesis right now, Rick. Maybe let's go like commodity by commodity. We'll start with uranium because you touched on Saskatchewan. You said maybe not hydrocarbons, but Saskatchewan's worth a look. And Saskatchewan is uranium. As we know, that's the big upside there. What are your thoughts right now on the uranium sector? You've been talking about it for ages at my show.
We could do a whole hour on uranium.
This is Jay Martin.
Suffice it to say, I love the fact that the social media posts around uranium are all negative.
Okay.
As a contrarian investor, there's nothing I love more than hate. And uranium is pretty hated, which is a good thing. People are paying attention to the wrong part of the market. They're paying attention to the spot market, which is increasingly irrelevant. Most days, the dollar volume of Sprott exceeds the dollar volume on spot. What's changing in the uranium market is the term market. But the term market requires people do work and pay attention to arithmetic as opposed to rhetoric. I'm hugely bullish on 10 or 11 or 12 uranium issuers. If you look at the length and breadth of the uranium business, say 100 listings, probably 85 of them are valueless. So if you pay attention to the sector, like any other junior sector, you're going to lose money. If you do securities analysis and you look at the impact on 10 or 12 viable issuers with the access to capital that would be facilitated to them as a consequence of the transition to a term market, you become hugely bullish on those issuers in the 5-year time frame. Another problem, Jay, that you and I both have as conference sponsors is that while many of our attendees have pretty good strategic perspective, 5-year, 6-year, 7-year perspective, they juxtapose 3-month tactics on 5-year strategies, and they fail. You can be right about the probable direction of copper over 5 to 7 years. But if you have trauma holding a copper stock over a long weekend, your long-term perspective is of less value. And teaching our attendees at both of our respective conferences that their tactics have to correspond with their strategies is probably the biggest single obstacle that both you and I face.
Well, then let's jump into that because you're absolutely right. And when I think about the uranium sentiment on Twitter, so often it's directly pointing to like yesterday's stock performance of a few early stage explorers. It's sort of abstraction. Security analysis, therefore, I think you have a rule for a high risk opportunity. You will only have as many high risk opportunities in the portfolio as hours in the month you can dedicate to each company, meaning you need 1 hour per month for every holding. Walk me through what you do in that hour. What are you reviewing? Are you revisiting why you bought the stock, the catalyst you're looking for, the reasons you might sell it? Like, what are you doing during that hour?
Whenever I buy a stock, Jay, I have a 1-page handwritten essay on why I bought the stock and what will constitute a mistake and what my target is and why I'll sell it. So I try to review monthly where I am in that circumstance. I pay attention, naked commercial, with the courses that I've taught at the Rule Classroom. I try to establish the value for every holding I have. And then I try to establish a prospective value if they answer unanswered questions correctly. What will a stock be like and be worth, not selling for, be worth in 2 years and in 5 years? And how does the selling price of the stock juxtapose itself to the value of the stock currently and the value that I see in the future? And in order to do that, I refer quarterly to the balance sheet and the income statement. I refer to insider trading to see if the insiders believe the rhetoric that they're giving the market. I look at, I love documents like preliminary economic assessments, pre-feasibility studies, feasibility studies. I understand that they're not gospel. I understand that they reflect the assumptions that goes into them, but at least they give me the baseline data so that I can construct my own models. But the most important thing is that I understand that money is made on the delta between the price of something and its value. Most investors don't want to do the work to establish the value, so the only information that they take on is price. You see that in the uranium thing. People are wailing and moaning because the price of uranium fell from 80 to 60, and the price of a uranium equity might go from $1 to 50 cents. If you believe in the thesis, the fact that it's cheaper is good for you, not bad. Just the whole ethos of this posting just cracks me up.
Mm-hmm.
Lower prices, things are awful. Well, if you believe in the prices, pardon me, if you believe in the thesis, lower prices are great, not bad.
There's a couple things I want to point to there. The first is that you started by saying you write a one-page essay determining why you bought the stock, mistakes that could happen, targets you have in mind, and what might make you sell. And I imagine what might make you sell could be good news or bad news.
Right.
So you want to corner it out. And that you allocate an hour per month to each one of these positions. And there's a couple important parts to that. Number one, writing an essay is something that's annoying and a lot of investors just don't do, aren't going to do, don't want to do.
Right.
But it's like anything, right? You get out what you put in, whether it's sports, business, relationships, or investing. It's directly correlated. More importantly, an hour per month speaks to your time horizon because, as you mentioned, a lot of folks will understand the 5-year macro trend, but will struggle to hold a stock for a month. And so every month, like how many months are we going to do this? So I imagine in that essay, you've also outlined your time horizon. Therefore, you have a good idea. How do you digest that part?
My expectation, some of my, as an example, I'm an aggressive speculator, so I speculate on exploration. If I'm looking for a big copper porphyry, the copper price 7 years from now is less important to me than whether I make a discovery. And it might be that the probability of that discovery will be enhanced or detracted from by the current work program. It may be that the current work program will take 18 months to discharge. If I don't have an 18-month horizon to get a yes answer, I have no reason owning the stock. If I think that the answer to the unanswered question will take me 18 months to decipher, if I don't plan on holding the stock for 18 months, how on earth am I going to get my yes answer?
Mm-hmm.
What is going to happen in the bull market that we're coming into in resources, Jay, is something very different. I had this occur recently. I bought an exploration stock on the anticipation that I would have an 18-month hold before I got a yes answer. The market for the stock in question doubled in 3 months before I had any answer to my question whatsoever, which is to say that my target price in the event that my answer was yes was achieved before the question was asked. In that circumstance, I sold enough stock to take all my money off the table and pay the capital gains tax. And the only amount I hold now is stock that is in effect riskless for me. So the intermediate selling isn't necessarily in response to a bad outcome. It can be in response to a market outcome that I consider to be irrational. My money is made on the delta between the price, which is a function really of investors' near-term voting perceptions, and what I think it's worth. Buffett says that there's a delta between the weighing machine, which is reality, and the voting machine, which is the market. And I believe that. My essay has to do with what I think things will weigh, as opposed to how people vote.
Yeah, that's an interesting one where you bought the stock, you had an 18-month time horizon before the catalyst you were looking for was supposed to occur. But in the meantime, sentiment swept in, rose the share price. And that's why it's so important for you to know that delta between the share price and the value of the company. And if you're not paying attention to that, you might just make the assumption that momentum is just getting started, right? And I don't know what it is relative to the asset that I own, but it's going up. So I'm right. I'm more right than I thought I was, right? Yeah.
And I'm not Jim Dines. I don't do popular culture. I don't understand the value of a narrative. That's not what I do. I'm a green eye shade guy, a lender.
And then the other thing I'll mention is that you sold your principal, right? Like once you had realized that gain ahead of schedule, the first thing you did was de-risk, sold the number of shares you needed to sell to recoup your invested principal plus pay your capital gains tax. And now what you have left is a completely risk-free ride, right? Whatever happens,
That's correct.
Just upside left.
Most investors think they're playing it safe, following mainstream advice, chasing trends, and clinging to the herd mentality. But there is nothing safe about mainstream advice. The smartest investors know that real wins come from thinking independently and spotting opportunities long before the crowd. And that's what we teach at the Commodity University. This is an exclusive membership designed to arm you with the skills from the sharpest minds in the mining investment world. Each of our professionals has a proven track record of finding trends before anyone else. At the Commodity University, you'll gain access to a highly curated and growing catalog of courses covering what you actually need to know to become an informed commodity investor. Every single month, you'll receive a brand new course packed with insights from the best in the business, giving you the edge to stay ahead. If you're tired of following the crowd and ready to invest smarter, think sharper, and understand the mining industry like the professionals, then take the next step and join the Commodity University today.